Hi guys, KP this side. Hope all of you are doing good. So we continue with the revision of concepts series in SFM, and I got so many messages asking me to make a video on portfolio management. So I thought, okay, let's honor it. You guys wish, and it becomes a command for me. Uh, so portfolio management. A disclaimer first of all, guys. If you are doing portfolio management for the first time, don't waste your 30-35 minutes. Don't waste your precious time. This is not for you. If you have not taken classes from me, I don't guarantee you will understand anything. I'm folding my hands, okay? I don't guarantee you will understand anything. I am only going to discuss some important formulas which we cover in this chapter. That's it. I'm not going in depth into anything, so please, if only for the purpose of quick revision of concepts you are watching this video, it will be helpful. But if the idea is to learn concepts, please don't watch this video, okay? I'm making this very clear right away. Now, starting with portfolio management, guys, I told you exam weightage for this chapter is close to 15 marks, but in certain exams we have seen that institute has thrown an element of surprise by raising the marks weightage to 20-25, and in some cases it has even gone up to 30 if we include portfolio management and mutual funds. So for portfolio management, if you remember, how did we start the chapter? We started the chapter like this, that there are three different theories that we study. The first one is called as modern portfolio theory. If you remember that, the modern portfolio theory, the theory was founded by Mr. Markowitz. So sometimes, if you remember, I showed you one exam problem where they did not refer to it as modern portfolio theory, but they asked the question by referring to Markowitz. So if they say Harry Markowitz, you need to remember that the theory relates to modern portfolio theory. The second theory that we studied, guys, was called as capital market theory. The capital market theory, they can also use the words Sharpe model or the Sharpe index model. They can use these two terms if they are referring to capital market theory. CMT, this is, I wrote CPT we cleared long back. We don't want to go back to those days. We want to finish off. Again I'm writing CPT. What is happening? Okay, CMT, capital market theory. So capital market theory is what I told you has the maximum weightage. One good reason for that is because you have the concept of CAPM and beta computation. Both of them fall under CMT. In fact, we discussed like this, that CMT ultimately transformed into CAPM itself, and so CAPM becomes an integral part of this particular theory. And the last theory that we did and is least tested in exam is called as arbitrage pricing theory, that is APT model. We had very limited coverage on this, but still you got to do it. What is the basic difference between the three theories? Let's talk that first. Modern portfolio theory is involving a lot of data crunching, lot of number crunching is there. In case of modern portfolio theory, we study the correlation between stocks. Okay, what is correlation? I will speak about it. We try to understand how two stocks are related, which means if I have ABCD in my portfolio, stocks ABCD, I try to understand the relation between AB, AC, AD, B, C, B, D, and like that CD and DB. Like that we have to see the relation between different stocks. So that combination of stocks is what we consider for the purpose of diversification of risk and all. But capital market theory says, if you remember that, capital market theory says that you should not waste time studying relation between stocks, because stocks are related to each other only because they belong to a common source. What is that common source? That common source is called as economy. You remember that? So we asked what is economy? How do you define economy? So CMT said economy is basically captured the best by a market portfolio. Economy is best captured by a market portfolio. So what you got to do is you should study relationship between a market portfolio and the stocks rather than studying the relation between the stocks. Stocks, how they are related to each other, we used to study in case of modern portfolio theory. But as far as capital market theory is concerned, it said no, you don't waste your time studying relation between stocks. You should rather try to study the relation between stock and the market portfolio. How do we capture the market portfolio? It is not possible to take market portfolio, because market portfolio by its definition is a portfolio comprising of all the stocks in the market. We can't create such a portfolio, it is unrealistic. So what we do is we use a proxy benchmark index like Sensex or Nifty. We use a proxy benchmark index like Sensex or Nifty to capture the market portfolio. I repeat, market portfolio is represented by a benchmark index like Sensex or Nifty, which means CMT says what you got to do is you got to study the relationship between Sensex or Nifty, any of the two index can be taken, and the stocks. This is what you should study. When we asked APT, do you agree with CMT? APT said two important points. Number one, as far as studying relationship between stocks is concerned, we should try avoid doing it. We should rather study the relation between stocks and the market portfolio, which means APT is agreeing with what MPT said. APT is agreeing with what CMT said. But as far as taking market portfolio as a representative of economy is concerned, that is absolutely incorrect. That is not a good sign. Economy is not just represented by a market portfolio. Economy is captured by a list of different macroeconomic factors like crude oil, GDP, employment rate of a country, interest rates. There are so many factors which become part of the economy. How can you say that economy is only captured by a market portfolio? No, that is not correct. And obviously, because two people had two different opinions, that is why CMT is different and APT is different. So is there any similarity between CMT and APT? Yes, there is a similarity. Both the theories say don't study relation between stocks, study relation between stocks and market portfolio. Okay, stocks and economy. How economy is defined? CMT says economy is captured by a market portfolio. For that we use index like Sensex or Nifty, but APT says no, economy cannot be captured just by markets. Markets do not define economy. The Sensex and Nifty cannot be a true representation of the overall economy. So for economy, you got to introduce some other factors like the macroeconomic factors, as I just told you, the list: crude oil, interest rates, GDP, employment rate, and so on and so forth. There are multiple factors to be taken, and that is the reason, if you remember, I told you, no surprise if they ask you this for theory in exam. CMT is a single factor model, but APT is a multi-factor model. Explain. Then whatever I said, that you need to explain in exam. That can come for theory for 4 marks, 4 to 5 marks, they can ask you this. Okay, starting with modern portfolio theory, guys, we will start with MPT now first. MPT, if you remember the first point of discussion that we have done, we first defined what is risk. I've already explained risk so many times, and in derivatives revision of concepts also I explained risk, but I'm telling it in short again. Risk is the deviation of actual return from average expected return. Any deviation of actual return, from average expected return. What is average expected return? That is mean return. Mean return is the average expected return. Any deviation of actual return from the average expected return, that is X bar, is called as risk. Now, how do you capture this risk? You remember, guys, risk is captured through variance. But variance is expressed in percentage square. So what we did, we introduced standard deviation. What is standard deviation? Standard deviation is a root over of variance, and we express it in percentage. So we learn both variance computation and standard deviation computation in portfolio management, but risk is primarily captured through variance, which is expressed in percentage square. So the basic definition of risk is always given in percentage square, but then we can also use standard deviation, which is basically a root over of variance and is expressed in percentage, and is easy to comprehend, also easy to understand. So we are more comfortable with standard deviation rather than variance. Okay, so any deviation of actual return from average expected return is risk. Average expected return is X bar, and variance is used to capture risk, which is expressed in percentage square. Standard deviation is root over of variance. Now what we studied further is that any rational investor is always trying to maximize his utility. You remember all this, guys? We are trying to maximize utility, and this utility is a positive function of return and is a negative function of risk. This utility is a positive function of return and negative function of risk, which means if return goes up, investors' utility will go up. If risk goes up, investors' utility will go down, which means you want to maximize the return and minimize the risk so as to create the maximum utility for an investor. Apart from that, next thing that we discussed was how can we create an optimum portfolio for an investor. I hope you remember, before we create an optimum portfolio, the first thing that we got to do is, separate the efficient from the inefficient portfolio. I hope you remember this. The efficient portfolio and inefficient portfolio should be separated, and only efficient portfolio will be considered in designing an optimum portfolio. What is inefficient? If you remember, 3 points were given. 3 points were given to understand if a portfolio is inefficient. Listen carefully, I'm not writing it now. Inefficient portfolio is the portfolio which generates same return at higher level of risk. Inefficient portfolio is one which generates same return at higher level of risk. Why should I take more risk if I'm getting same return? I would rather take less risk to generate same levels of return. So if I generate same return at higher level of risk, that is inefficient, number one. Number two, if we are generating if we are having same risk but lower level of return, same risk but lower level of return, if I'm taking same exposure but I'm getting lower return, why would I invest in such portfolio? I will not invest. Think rationally. Same return, higher level of risk, no, I'm not going to take it. Same risk, lower level of return, no, I don't want such a portfolio. And third case is when you are having lower return and higher risk. Lower return and higher risk, this is the worst possible case. We can't invest in a portfolio where we get low return also and we are taking higher levels of risk also. No, we don't want such a portfolio. So first thing that you need to do is you need to find out the efficient portfolio, and once you find out the efficient portfolio, after that you will have to find out the optimum portfolio. So first thing that we do is we find out the efficient portfolio, and from that efficient portfolio we will then find out the optimum portfolio. Now how do we find out optimum portfolio? If you remember, again we discussed three different things for this. How do we find out the optimum portfolio? If you remember, so first thing guys is to separate the efficient from inefficient based on three criteria which I already explained. Once you have efficient portfolio, you will again use three different measures to find out the optimum portfolio. The first method is if the risk attitude of the investor is known to us. Risk attitude of the investor is known to us. What did we discuss in this? If an investor is risk aggressive, risk aggressive means you don't mind taking risk. What we need to do? We need to do return maximization. If investor is risk aggressive, we try to maximize the return. If investor is risk averse, what do we mean by that? Risk averse. Risk averse means we don't like taking risk. If we don't like taking risk, the idea is to minimize risk. Minimize the risk. So if you are risk aggressive, we will try to maximize the return. If you are risk averse, we will try to minimize the risk. Based on that, we will decide what is the optimum portfolio for an investor. That's the first criteria. The second criteria is we calculate something called as coefficient of variation. You remember that? Coefficient of variation. I told you don't learn the formula. First you learn the sentence. We learn the formula in a form of sentence. What is that sentence? If you remember, risk per unit of return. Guys, you remember that? Risk per unit of return, which is basically SD by mean. Mean means average return. SD by mean into 100. That is second formula which we use. It's called as coefficient of variation. And obviously this is lower the better. This is lower the better for us. So coefficient of variation is SD by mean into 100, which is lower the better. And lastly, what we discussed was Sharpe ratio. How did we learn this, guys? How did we learn Sharpe ratio? Again, a statement was given to you in the class. How did we learn Sharpe ratio? It is additional return per unit of risk. Additional return per unit of risk means return from the portfolio minus risk-free rate divided by sigma p. Sigma p means standard deviation of the portfolio, and this is additional return per unit of risk, and obviously this is higher the better. Higher the better. So three criteria for making selection of the optimum portfolio. First is risk attitude of the investor. If investor is risk aggressive, we'll try to maximize his return. If investor is risk averse, we'll try to minimize the risk. Second is coefficient of variation, very popular and very much tested in exam. What is coefficient of variation? It is risk per unit of return. How do we calculate it? It is SD by mean into 100, and we always prefer lower. What is the third category? Third category is Sharpe ratio. What is Sharpe ratio? It is additional return per unit of risk, which is RP minus RF divided by sigma p, and this is higher the better. And in language terms, we say additional return per unit of risk. I hope this part is clear, guys. So we're done with the first part of our discussion. Point number 2, how do we calculate the return and risk of the stock? I hope you remember this. Return and risk of the stock. How do we calculate return and risk of the stock? For this, I told you, we first find out whether they have given us past data or they have given us future data in exam. Whether they give you past data or future data. If they give you future data, just understand they will definitely have to give you the probability distribution of return. If they give you past data, they will just give you the past few years return. If they give you future data, how do you know if it's future data? They will give you probability distribution of returns. In case of past data, return computation is very simple. X bar is equal to summation of x divided by n. That is it. Return computation is very simple. You simply find out the simple average of all the past years. How much did you get return in last 5 years from a stock? 10, 11, 12, 13, 14. These are the 5 years return. 10, 11, 12, 13, 14. What is the average expected return? That is x bar from the stock. Okay, it is 10 plus 11 plus 12 plus 13 plus 14 divided by 5. That's it. Simple average we have to do. That is x bar is summation x divided by n. Okay. What is in case of future data, how do we do it? Future data, I have told you guys, whenever probability distribution is given, we use one simple formula, and this formula remains same throughout your SFM, which is summation px. P is the probability, x is the expected value. X is the expected value, P is the probability, and you do the sum total of that, summation px, and you get the answer. This is return computation in case of past and future data. How do we capture risk? Risk is captured using the formula. If you now try to understand how the formula we derive and how we remember it, I told you any deviation of actual is x, any deviation of actual from average is x bar, is risk, isn't it? Any deviation of actual from the average, actual is x, average is x bar, is the risk. We do the square of it because risk is always captured in terms of percentage square, and then we divide by n because we are talking about past data. We will have n in that case. And we do root over because we are calculating standard deviation. If you're calculating variance, don't do square root, but if you're calculating standard deviation, you will do root over of this. So summation x minus x bar whole square divided by n, and then the root over of it. If you're dealing with future data, then the only difference is everything remains same, just that instead of n you will have p. So we have in this case summation px minus x bar whole square, and then the root over in case of standard deviation. If it is variance, you leave it like that. You don't do any computation further. Apart from this, I hope these formulas are clear, guys. Apart from this, I told you we have three types of sums. Level of difficulty, if you remember, I gave you level of difficulty 1, level of difficulty 2, level of difficulty 3. I gave you 3 different points over here. Level of difficulty 1, that is the easiest cases. They will directly give you the return information. Use that return information, use the formula which you see on the board right now, and just find out the return and risk of the portfolio. Second category sums is where they don't give you return data, they give you price and dividend information about the stock. Price and dividend information about the stock. If they give you price and data information about the stock, the first thing you got to do is you got to calculate the return. You got to calculate the return first, and then using that return you will calculate the average expected return and risk of the stock, either using past data or future data, that does not matter. So first thing that you need to do is level of difficulty 2 is then you need to first find out the return, and for calculating return we use the holding period return formula. If you remember that the holding period return formula is P1 minus P0 plus D1 divided by P0 into 100. P1 minus P0 plus D1 divided by P0 into 100. That is holding period return formula. This formula is used to calculate the return. Using that return data, then you will find out the return and risk of the stocks, average return and risk of the stock using the above formulas which are written on the board. When using holding period return formula, again I gave you one important point to remember, that if at the beginning of the first year, that is 0th period today, if the price today is not given, then I cannot calculate the return for first year, and I will have to start my calculation from second year. I hope you remember that, because in my formula one is P0 is the price today. So if at the beginning of first year price is not given, then you won't be able to calculate return for first year. Your calculations will start from second year, which means if P0 price today is not given and total 5-year data is given, then your computations will be only for year 2, 3, 4, 5. If they give you P0 also, then you will calculate return for year 1, 2, 3, 4, 5, like that. Level of difficulty 3 is where they don't give you price, they don't give you return, nothing is given, and we did a sum like that in the class if you remember. Then the first thing you need to do is you need to calculate the price, and for calculating price I told you generally they test you on two formulas. One is D1 by RE minus G, what we call as constant growth DDM or Gordon model. P0 is equal to D1 by RE minus G, or we can calculate it using the PE multiple approach, where it is PE ratio into EPS. One of these two formulas is used to first calculate price. Use this price information, find out holding period return, use this holding period return formula, and then calculate the return and risk of the stock. This is how we have to proceed. I hope you are clear with this. Okay, level of difficulty 3 is where you first calculate price using any of these two formulas, either the constant growth DDM or PE ratio into EPS. Then you find out the holding period return, which is P1 minus P0 plus D1 divided by P0 into 100, and then using this information you calculate the return and risk of the stock. I hope guys this is clear. After this, next point number 3 that we discussed was return and risk of a portfolio. Return and risk of a portfolio. What is a portfolio, guys? What is a portfolio? A portfolio is created when I am putting my money at least in 2 stocks. A portfolio is created when I put my money at least in 2 stocks. If I have more than 1 stock, I call it a portfolio. If I invest in more than 1 stock, for me it becomes a portfolio. How do you calculate the return of a portfolio? Return computation is very simple. It is expected return from the portfolio is equal to weighted average. It is weighted average return. I hope you remember, which means if I have 3 stocks in my portfolio, A, B, C, then my return from the portfolio will look something like this. Return computation is very simple. It is simply the expected return from the stock multiplied with its weights. Based on the investment amount, you calculate the weights, weighted average return. How much of my money I am putting in each of the stocks multiplied with expected return. Tell me, is this fine? Return computation was never difficult. What is difficult is risk calculation. How do we calculate risk? Which is sigma p of the portfolio, standard deviation of the portfolio, is equal to weighted average risk. Can I say that? Then I told you no, this is not correct. Sigma of the portfolio is not equal to weighted average risk. It is less than weighted average risk. Why is it less than weighted average risk? You studied this in CFPM in derivatives chapter. Why risk of a portfolio is less than the weighted average risk? Because we get some benefit of diversification. We get some benefit of diversification by putting our money not just in one stock and putting it in across different stocks. Because once you put your money across different stocks, you are able to get rid of unsystematic risk. Do you remember, guys? We get rid of unsystematic risk once we diversify the money. But the question is, how much is the benefit of diversification? How much is the benefit of diversification? That will depend on the correlation between the stocks. You remember all this? That will depend on the correlation between the stocks. So we can have 3 types of correlation: positive correlation, negative correlation, zero correlation. Zero correlation means you're not able to understand the relation between 2 things. Positive correlation means both are moving in the same direction. Negative correlation means both are moving in the opposite direction. Correct? No? So what I said, I'm repeating it. Standard deviation of a portfolio is not equal to weighted average risk. Standard deviation of a portfolio is less than weighted average risk. Why it will be less than weighted average risk? Because once you put your money across various stocks, you will get some benefit of diversification. How much is the benefit of diversification will depend on the nature of correlation between these stocks. That is, stocks can have positive correlation, stocks can have negative correlation. Negative correlation is what will generate more benefit of diversification, because stocks are moving in opposite direction. So even if I lose money in one stock, I can still create wealth in the other stock. That is the benefit of diversification. So as you move towards more and more negative correlation, the benefit of diversification will increase. As you move towards positive correlation, the benefit of diversification will reduce. If we have a perfect positive correlation, you remember that perfect positive correlation is R is equal to 1 case. R is the correlation, R is equal to 1. Then in that case, sigma p is equal to weighted average. Sigma p is equal to weighted average because you will not get any benefit of diversification in that case. Only when R is equal to +1, that is both stocks are exactly going up, exactly going down, then in that case there is no benefit of diversification and you get sigma p is equal to weighted average risk. Now the question is, this diversification benefit, how do we capture it? How do we capture this diversification benefit? For that, what we did, we introduced something called as covariance. You remember, this is covariance. This is not coefficient of variation. Coefficient of variation is what we studied in the beginning of the chapter. Coefficient of variation is risk per unit of return, that is SD by mean into 100. This is covariance. What is covariance? Covariance is joint deviation of x around x bar and y around y bar. This is the sentence which we learned. joint deviation, because see, variance is deviation, covariance means joint deviation of x around x bar and y around y bar. Okay, what is the formula? Formula is very simple. In case of past data, it is summation x minus x bar into y minus y bar divided by n. That is the simple formula of covariance in case of past data. What is the formula in case of future data? Needless to say, you would have already understood. Instead of n, we will have p, because future data will always have probability. Summation p x minus x bar into y minus y bar. Summation p x minus x bar into y minus y bar. We use covariance for finding out the correlation between the stocks, and that will help us understand how much is the benefit of diversification. But we don't prefer to use covariance because there are two problems with it. One problem is it is expressed in percentage square, because when variance is expressed in percentage square, obviously covariance will also be expressed in percentage square. Another problem with this is its value can range anywhere between minus infinity to plus infinity, which means sometimes you might have a value of 5000 for covariance, plus 5000, minus 5000, minus 50,000, plus 2000. Like those kind of values also you can get, because they are ranging anywhere between minus infinity to plus infinity. So the problem is, minus answer will make us understand it's a negative correlation, but we don't know how good or bad it is. Okay, because the values have no range, there is no standard range. It can range anywhere between minus infinity to plus infinity. So only thing you can understand is whether it's negative correlation or positive. How much negative it is or how much positive it is, that is very difficult to understand. So what we did, instead of covariance, we introduced something called as correlation coefficient. And this correlation coefficient is basically denoted as R, and this R is calculated as covariance, that is covariance between, let's say, two stocks A and B divided by sigma A into sigma B. This is the formula of correlation coefficient, which is R is equal to cov AB divided by sigma A into sigma B. Biggest advantage of this is that it can range only between -1 to +1, making it more easy to interpret. The values can range only between -1 to +1, making it more easy to interpret. So we don't use covariance, we rather prefer to use correlation, because correlation has no percentage square expression and all. It can only range between -1 to +1, giving it more meaningful interpretation. But then you can't avoid learning covariance, because for calculating correlation you first need to find out covariance, because correlation numerator is covariance itself, which is cov AB divided by sigma A into sigma B, and it can range between -1 to +1. So now guys, we have understood what is covariance, what is correlation. Now we need to find out what is the standard deviation of a portfolio. So in that case, if you remember, I told you standard deviation of a portfolio is calculated for 2 stocks or for 3 stocks. If for 2 stocks, when we do it, we keep in mind this formula: a plus b whole square is equal to a square plus b square plus 2ab, and because it is standard deviation, there is a root over, so we remember this is the formula of it: weights of a square into sigma square b plus weights of b square into sigma square b plus 2 into wa into wb into covariance between a and b. This is the formula which we use for 2 stock portfolio: weights of a square into sigma square a plus weights of b square into sigma square b plus 2 into wa into wb into cov ab. Now if covariance is not given, then if you look at this, particular formula, from here we can understand one thing, that cov AB is equal to R into sigma A into sigma B. Can we say this? Cov AB is equal to R into sigma A into sigma B. This can also be said. So what we also do is, we can have an alternative formula over here, which is root over of weights of A square into sigma square A plus weights of B square into sigma square B plus 2 into WA into WB into R into sigma A into sigma B. This formula can also be used. So if they give you the covariance value, then use the formula which is written in red color, and if they give you the correlation value, that is R value is given, then go for the formula given in blue color. That's how you have to understand the difference. Okay, and how did we get this formula of covariance? From the correlation formula itself. If R is equal to cov AB divided by sigma A into sigma B, then obviously cov AB is equal to R into sigma A into sigma B. I hope guys this is clear. After that guys, if you remember, 2 more things are left in modern portfolio theory. The first thing that we discussed was, for 2 stocks, how can we create a minimum risk portfolio? You remember that? So how can we generate the least risk for a combination of two stocks? And for that we use the minimum risk portfolio formula, where we have the weights of A is equal to, if you remember like this, we have learned variance of B minus cov AB divided by variance of A. We have done everything in the form of sentences. Variance of A plus variance of B minus 2 times the covariance of A and B. That's how we have learned it, right? How do we, with two stocks, if I want to achieve a minimum risk portfolio, that is use the weights of two stocks in such a way in a portfolio that we are able to achieve the least risk for that portfolio, then we use this formula. That is, we calculate weights of A. When we calculate weights of A, in the numerator we take variance of B, which is sigma square B minus cov AB. Variance is sigma square, standard deviation square is variance, divided by sigma square A plus sigma square B minus 2 times the covariance between A and B. That's the formula we use. Sigma square B minus cov AB divided by sigma square A plus sigma square B minus 2 times the covariance of A and B. Apart from this, one more thing I told you, that is the computation in case of short selling of stock. If you remember, I told you if we short sell something, then while calculating the weights, if we are supposed to calculate the weights, we take negative sign. If you remember that, negative sign will be taken in computation of weights if you have taken a short selling position on a stock. You sold something because it was overpriced. So in that case, I told you that we take negative weights, and after that I told you, remember two things to cross check your answer. You should always calculate weights based on own funds invested. You should always calculate weights based on own funds invested. And number two, you should always see at the end the sum of weights should come equal to 1. Two things are important to keep in mind. Number one, in case of a concept of short selling, if you short sold some stock, you assign negative sign to it while calculating weights, and even calculation of return and risk, you take negative weights for that. While calculating weights, remember two things. Weights should be calculated based on own funds invested, not the proceeds you get from short selling. Number two, sum of weights should always be equal to 1. That you need to remember. Okay guys, after that we moved on to the next theory, and that theory is capital market theory. In capital market theory, the most important point of discussion that we have done is beta computation. If you remember that, beta computation can be done in different ways. I told you, if only 2 period data is given, then we calculate beta as change in stock return divided by change in market return. That's the first formula we have done. Beta is equal to change in stock return divided by change in market return. This formula is to be used when only 2 period data is given. Beta can also be calculated by using the CAPM equation, that is RE is equal to RF plus RM minus RF into beta, which means what you can do is you can use the CAPM equation, key in all the other information, either directly given or you need to calculate. We have done variety of sums on this. RE is equal to RF plus RM minus RF into beta. We put all the other information, that is RE, RF and RM, and then using that information we calculate the beta. The third method for calculating beta of the portfolio, if you remember, is by using this formula, summation Wx divided by summation W. This is what we have done in derivatives also. Summation Wx divided by summation W. What is that? It is the weighted average beta of a portfolio. That is summation Wx, where W is the weights. Weights are the market value of investment in each stock. X is the beta value. So summation Wx divided by summation W. That's how we calculate beta of the portfolio. Apart from that, beta can be computed statistically. Statistically, when we calculate beta, if you remember, that's very, very important. We learned something. There is a characteristic line equation where we write it like this: Ri is equal to Ri is equal to alpha I plus beta I Rm plus Ei. This is the equation of characteristic line. This is the equation of characteristic line. They might ask you to write down this equation, and then they ask you about two parameters. There are two parameters of this. One is alpha, one is beta. Correct? You remember this? What is the equation of characteristic line? Ri is equal to alpha I plus beta I Rm plus Ei. What is Ei? Ei is the error term. If you remember this, Ei, it generally represents the unsystematic risk. And this unsystematic risk is, if nothing is given, we take it as 0. Unsystematic risk of the stock is EI. Nothing is said, we take it as 0. Beta I represents the beta of the stock. Alpha I represents the intercept of the stock. The alpha is basically the return expected from the stock when market return is 0. Alpha represents the return from the stock that is expected when market return is 0. Beta represents the return expected from the stock for 1% change in market return. These interpretations you have to write in exam. Okay, this equation is in the form of y is equal to a plus bx. If you remember that, where a is the intercept, how do we calculate a? It is y bar minus b into x bar. If for alpha computation we use this equation, a is equal to y bar minus b into x bar. Y bar is the average stock return. This is average stock return. X bar is average market return. Y bar is average stock return. X bar is average market return. So alpha calculation is done like this, and once you calculate alpha, suppose alpha comes as minus 5%, it means that if market return is 0, then stock is expected to generate a negative return of minus 5%. Stock is expected to generate a return of minus 5%. That is alpha computation. How do we calculate beta? Beta is calculated as summation. Beta is equal to covariance of x and m. X is the stock, m is the market, divided by sigma square m. This is the fourth formula used for computation of beta. Beta is cov xm divided by sigma square m. Beta is equal to cov xm divided by sigma square m. Or beta can also be calculated as, we know cov xm can be written as r into sigma x into sigma m divided by sigma square m. The sigma m and square will go off, then we get r into sigma x divided by sigma m. This formula can also be used for calculating beta, which is beta is equal to covariance between stock and market divided by variance of the market. Always remember, denominator of beta formula is variance of the market, or we can calculate it as r into sigma x divided by sigma m. These are the two parameters of the characteristic line equation. Alpha explains return from the stock when market return is 0. Beta explains expected return from the stock for 1% change in market return. So there are total 4 formulas which we have learned for calculation of beta. First is, if only 2 period data is given, just calculate beta as change in stock return divided by change in market return. Second, they might give you information about RF, RM. In that case, you use CAPM to calculate beta. Key in the information about return from the stock, that is RE. RF is the risk-free rate. RM is the return from the market. Key in that information and then calculate beta. Beta of the portfolio can be calculated as a weighted average beta, which is summation wx divided by summation w. W is the weights which is given to the market value of investment in each stock. And lastly, I told you we can use characteristic line, which is alpha I plus beta I rm plus ei, where alpha is the intercept, beta is the the slope of the equation, and you know what beta represents. So alpha and beta formulas are written. Alpha is y bar minus b into x bar. Beta is covariance of stock with market divided by variance of the market. This is one topic which generally comes in every attempt in exam. So you need to do, we have done a lot of sums, guys, and a lot of homework sums were given to you. Make sure you do that part properly. How can we use CAPM to find out the overpriced stocks? You remember, for that what we do, we make comparison of expected return and RE. ER and RE are compared. If ER from the expected return from the stock is greater than RE, RE is my requirement, what I want. ER is what stock is expected to pay. RE is what I will be happy getting. ER is what I expect stock will actually pay. If ER is greater than RE, I will be happy because stock is paying me more than what I need. So for me, the stock is underpriced and we give a buy recommendation. We will be happy to buy such stocks which are going to give me return more than what I want. Case 2, if ER is less than RE, stock is paying less than what I expect, what I require, then for me the stock is overpriced and we give a sell recommendation. So ER and RE comparison is done. If ER is greater than RE, we say the stock is underpriced and we give a buy recommendation. If ER is less than RE, we say the stock is overpriced and we give a sell recommendation. Now in this, one very important thing you need to remember is RE will always be calculated as per CAPM. RE is always calculated as per CAPM. RE is always calculated as per CAPM, whereas ER, that is expected return, can be calculated, either it will be given to you or you need to calculate it. How we calculate it? One formula is summation px, one formula is holding period return we can calculate, which is P1 minus P0 plus D1 divided by P0 into 100. And one more formula for calculating expected return is dividend yield plus growth rate, which is D by P plus G. These are the three formulas I told you. If expected return is not given, any one of these will be tested in exam based on the past papers. I'm telling this to you. Either it is summation PX, or it is holding period return, or it is dividend yield plus growth rate, which is dividend by price plus growth. Apart from that, in the capital market theory, one more point of discussion we have done is how systematic risk is calculated. If you remember, systematic risk is equal to beta square into sigma square m. Beta of the stock, we do square of that into variance of the market. Sigma square m means variance of the market. That's how you calculate systematic risk. Unsystematic risk is E square, that is the error term, that is unsystematic risk is captured through error term, and we take E square, and then we find total risk, which is systematic risk plus unsystematic risk. Unsystematic risk can also be calculated as total risk minus systematic risk. Again, this part of discussion is important, guys. These formulas, don't take them lightly, some can come in exam. Okay, so systematic risk is beta square into sigma square m. Unsystematic risk is E square, that is error term. The square of that you have to do. If error term is not given, then you have to remember that total risk is systematic risk plus unsystematic risk. In that case, unsystematic risk is basically total risk minus systematic risk. That you need to remember. Okay, apart from that, if you remember, I gave you one more formula for covariance in capital market theory. CoV is equal to beta A into beta B into sigma square m. If you remember that, this formula of covariance can be used only when we are studying capital market theory related sums. Beta A into beta B into variance of the market will help you calculate cov AB. Similarly, if I have to calculate covariance between B and C, I can do it beta of B into beta of C into covariance of the market, that is sigma square m. Okay, please remember this. Okay, so that brings us to the end of the capital market theory, and the last theory, which is arbitrage pricing theory. Main focus has to be, guys, on the equation. For the equation, I told you the equation is similar to CAPM, but in this case we take it as RF plus FRP1 beta 1 plus FRP2 beta 2 and so on. This is if there are two factors, we write the equation like this. If there are three factors, equation will be RF plus FRP1 beta 1 plus FRP2 beta 2 plus FRP3 beta 3. Like that we have to do. So in this case, you need to remember one thing. This and this is going to remain same for all the stocks. Risk-free rate is same. Factor risk premium is basically playing the role of market risk premium, that is RM minus RF in CAPM equation. Factor risk premium is factor specific. This is factor specific, not stock specific. And beta is stock specific. Okay, suppose we have two factors, GDP and crude, and the premium is given 6%, 3%. We are talking about Reliance. Reliance beta to GDP is 1.25 and to crude is 2 times, and RF is given as 6%. Data is given like this. What is the return of expected return of Reliance as per APT? 6 plus, okay, let me take this as 5. GDP risk premium is 5, so this 5 into 1.25 plus 3 into 2. That's how you will calculate RE as per APT model, which means 6, 5 and 3. These three numbers, if you see the 6, 5 and 3, they will remain same whether I'm talking about Reliance or I'm talking about Infosys or I'm talking about any other stock. These three things will remain same. What will change is only the beta values. Each stock will have a different beta value to each of the risk factors. In this case, Reliance has a beta of 1.25 to GDP and beta of 2 times to crude oil. So we have put that numbers. If we are talking about Infosys, I will again have to find out what is beta of Infosys to GDP and what is beta of Infosys to crude. Then those values will be replaced. But 6, 5 and 3 will remain same. They are not going to change. What did we discuss apart from this in portfolio management? We have done portfolio rebalancing strategies. I did 2 sums. One I solved in the class, one I gave you as a solved illustration. That constant proportion portfolio insurance policy is more important. CPPI is more important for you from exam perspective. It has already come a couple of times in exam. If you remember, guys, what we used to do in that was we used to invest part of the money in equity and part of the money in the risk-free securities. What we invest in risk-free securities is for creating that insurance kind of a thing. So what we do is we calculate the floor value, if you remember. So if my portfolio is worth 3 lakhs and maximum fall is 10%, then my floor value is 2,70,000. If you remember that, then they will give you something as M, that is multiplier. Suppose multiplier is 2 times, then how much is the investment in equity? Equity is portfolio value minus floor value into M. That's how we calculate portfolio value minus floor value into M. So portfolio value is 3 lakhs, floor value is 2,70,000 into M is 2, which means 30,000 into 2, 60,000 we are getting, which means 60,000 will be invested in equity and balance of 2,40,000 will be invested in risk-free securities. And then after 10 days or 15 days, they will ask you to do the reshuffling of the money. Again, you will use the same formula. Equity component will change, risk-free securities will remain same, but based on change in the portfolio value, you will again put this formula, find out the equity investment. Whatever comes in equity, the balance will go in risk-free securities. This is the main discussion we have done in total portfolio management. I just hope that I did not miss on any important points of discussion. If I did, mention it in the comments. There are no grudges, right? You just mention in the comments that we did not cover any particular point over there. So we did videos on forex, we did on derivatives, we did on equity, we did on portfolio management. Honestly speaking, guys, I think this is enough. Rest of the chapters, I don't think I can add a lot of value. Making videos for bonds and mutual funds will not serve the purpose. There's no point wasting your precious time. I am free, it's locked down, I can do it, but there's no point doing it, guys. So let's not be hopeful that I will be making more videos now. What are the important chapters? For that I have made video. This will help you save a lot of time. See the videos multiple times. You're sitting idle, have half an hour, just play one derivative video and listen to it. Idea is not to listen to the videos once, idea is to listen to them multiple times so that you are clear with your concepts. Make use of this time, guys. Your exams have been postponed again, but don't take it lightly. We need to crush the CA finals this time. So best of luck, guys. Give it your best. Do it for your parents. Bye bye. God bless all of you. Thank you, guys. Thank you.